Hey everyone, Steve here from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ish collective. As someone who's grown up and spent my entire career in the Silicon Valley, a company like Forge Global, whom we will be talking about today, they mean a lot to me because my background as a developer, as a product manager, as an entrepreneur, and as an investor, this company, it checks all the boxes in terms of what I do and what I'm passionate about. So, in this video, let's talk about what Forge Global is, what are the pros and cons of this company, and how it might fit in your portfolio. Even before I talk about what Forge Global does, let's talk about how startups work, generally speaking, especially in the Silicon Valley. The fundamental thing with startups is that they expect you to take a pay cut and expect you to work your ass off. Because A, they don't have much money, being that it's a startup idea, usually they're bootstrapped. And two, they expect you to work your ass off because the expectation is you work your ass off, you generate a ton of value as quickly as possible, and people get paid out in a big way. How do you get paid out? With stocks, right? You're offered private shares because these are not public companies when you've successfully made a company into a big, giant, juicy piece of, monetary sum worthy company. You can either sell it and then your private shares will become, like translated from X shares equals X dollars, or it goes public so that X shares equals X dollars. Either way, the idea here is you'll make the most of your money working your ass off, getting underpaid through stocks. Now, I'm sure you've heard this idea that most businesses fail. So how do you try to hedge your bet, if you will? How do you make sure that you can still cash out? A company like Forge Global does that. There's also another one called Equity B. There's a couple of others. But the fundamental principle is that it's a secondary market that allows you to sell your private shares before the company is ready to essentially convert those private shares into cash. You basically put your money out there onto this exchange and you say, I'm willing to sell these shares at this price. If someone is willing to pay for it, then you'll be able to cash out, right? That is the beauty of Forge Global. There are tons of startups every single day. There are tons of them who's been around, even though they're called startups, they're around for like 8-9 years. And people are looking for ways to cash out, right? Because they've been toiling and working their ass off for so long that they want to get more value out of all of the stocks that they've accrued. One of the things that most people don't know about, unless you're in this industry where you've signed a couple of stock options, is that there's actually always a fine print, almost always a fine print, that says that the people who employed you actually can have the right to buy your shares back. What that means is that if you decide to sell it on an exchange like Forge, and the company actually doesn't want that to happen for whatever reason it is, they can actually force you to sell your shares back to the company. It's kind of blurry in terms of at what value it is because usually it states at market value. So market value in itself is open for interpretations, right? So that is actually one of the biggest concerns of mine for secondary markets like this. But after the old founder of Zynga screwed over a bunch of people doing exactly that, you really don't hear about that happening again because that's just bad faith, right? Someone worked their ass off to actually earn these shares, and then the company decides to buy your shares back at a very, very low price because they think that they've flooded the market with too many, et cetera, right? That in itself shouldn't happen. But technically, legally, it's within the contract for it to be able to happen, right? So that's one thing you should definitely watch out for. Second thing that I think you should really watch out for a concept like that, the second thing you should really watch out for a concept like this is that I really truly believe that the moat is weak, this business idea. Startup people, startup employees, they cherish an idea like this, right? It gives them a way out. I'm 100% on board. But even for someone like me, who's interested in selling some of my shares in the past startups that I worked in, it's hard for me to figure out which one's the right one to go with, you know? It kind of gets this Craigslist feel where you kind of assume that, okay, these companies have serious backers, so my money, my private stocks are probably in good hands. There's no funny business, therefore I'm going to put my money there, right? That essentially is the moat, because the transaction is more of a legal contract kind of a thing, and finding you someone who's interested, like, they need to do a really really good job to do that, or they just need to search engine optimize to find you people who might be interested in buying your shares. So I find that the company's moat is kind of weak. However, this company is backed by Peter Thiel, and that to me is a big deal, right? He's a serial entrepreneur who just doesn't. It might take some time for the companies to show real value, but fundamentally, I think this is a very, very reasonable bet. The third con I want to really highlight that I think has the biggest risk is the fact that, if you frankly talk to anybody, people like me, we're invested in the market, but we're very, very scared about the downside right now because the market is acting very abnormally. But it's so frothy that it's hard for us to stay away from it, right? This actually plays hand in hand with startups. And what I mean by that is there are a lot of startups when there is a lot of money. When the market goes down, that liquidity kind of dries up and a lot fewer startups exist. A lot of startups go bankrupt because everyone is really tying up their bootstrap, slimming their belt, however way you want to call it. If that happens, right? If you believe that this is true, then my hypothesis is that there will be fewer people who are posting, selling, and buying off of secondary markets for startups because that's just risky, right? One of the biggest indicators that a lot of people don't know this is that when a market looks very, very frothy, on the edge of too frothy, a lot of companies go public during that time period because that's the best time. They don't want to miss that window because after that, it'll be very hard for them to go public and still make a ton of money. MOTV as a reverse merger at $10 a share with such a beautiful idea that should exist, right? With backers, legit backers that knows how money works, right? Peter Thiel was part of the original PayPal crew, right? I mean, I think this is a legit business to invest in, but it is absolutely not without risk. So I highly recommend that if you were to invest in this company, take that into very, very high consideration. I wouldn't personally put anything more than, let's say, 1% of my bankroll into this investment opportunity at this time. I really want to see how things play out and go from there. The biggest way for this company to get real value is they need to expand their ecosystems into other spaces where it's less seasonal, or they get sponsorships. That, in my opinion, is how a company like Forge Global can expand bigger and bigger regardless of the economic climate. So let's see what they do next. So I hope this content was helpful. If you have any questions or concerns, please leave me a note. Thanks for watching, and I look forward to working with you next time.